The broadcast is now starting. All attendees are in listen-only mode.
A warm welcome to everyone on the line to this live session at Best Ideas 2021. It gives me great pleasure to welcome to this session returning MOI Global instructor Amit Wadhwaney, portfolio manager and co-founding partner at Moiris Capital Management and the founding manager of the Moiris Worldwide Value Fund. Amit has more than 25 years of experience researching and analyzing investment opportunities in developed, emerging, and frontier markets worldwide, and has managed global investment portfolios since 1996. I'm not going to go through Amit's entire background, except to say that before Moiris, he was a portfolio manager and partner at Third Avenue Management. He founded the international business at Third Avenue and was the founding manager of the Third Avenue Global Value Fund, the Third Avenue Emerging Markets Fund, and the Third Avenue International Value Fund. And those of you in the MOI community who've been with us for some time will know and truly appreciate the ideas, insights, and wisdom that Amit has so generously shared with our members. And with that, with a big expression of gratitude, Amit, I'd like to now turn it to you for today's presentation. Please go ahead.
John, thank you very much for the kind introduction. Welcome all, whichever time zone you may be listening to from, be it live or to a recording of this call. Before I get started with the topic at hand, first let me direct your attention to the disclaimer, which is shown in very fine print on this slide. Let me leave it up for probably a few seconds so that you can at least scan it, if nothing else, to say that you have an idea as to what the disclaimer is about. Then a couple of words by way of a background to Moiris, which might be pertinent to the subject at hand. We, Moiris, are an employee-owned firm which is focused on disciplined value investing. This is something which I've been doing for almost 25 years, and it continues to this day. I mean, this slide really gives you a snapshot of our investment philosophy. It sort of highlights a number of characteristics of our investment approach. I mean, if value investing has been unfashionable in recent times, then our corner of value investing even more so. We're very risk averse. We tend to weigh asset values more than income statements in our security selection process, something that runs completely counter to the revenue and perhaps earnings growth focused investing approach that dominates public consciousness today. And to be clear, what I will be speaking about today is investing in the long-term time horizon, ideally 3 to 5 years or more, a concept that would appear to be increasingly out of step in this day and age of day traders. Now, I just note, I flag a couple of items on this slide. One is our asset-based approach. It's a balance sheet-led approach as opposed to earnings-focused. A valuation that's based on the here and now. And importantly, we really do focus on getting things at as high a discount as possible. I realize a lot of what goes on today, it tends to be sort of focused on relative valuations. Ours focus on absolute levels of discount. So one of the reasons why we do this, we focus on the asset value embedded in the investee company, assessing the here and now, because we really want to make as few assumptions as possible about the future, which we consider inherently unknowable, with the level of precision that is necessary to make an investment decision. So armed with what we consider to be a conservative valuation and an understanding of the dynamics of the business, we attempt to arrive at a decision relating to the investment. Now, take this a step further. From analyzing a single entity to one which values multiple discrete entities, we now have the tools for analyzing a holding company, holdco for short. A typical holdco is an entity which holds multiple assets or businesses to which we can subject to our analytic approach. Usually, the analysis begins and ends for most people with assessing whether shares trade at discounted net asset value. and with the constituent valuations being done in a conservative manner. But to us, that's just the starting point. So we ask the following other questions, and this is sort of our quick checklist for investing in holding companies. Usually, most analysis stops after assessing whether the discount is above or below historic levels, and based upon this data point, the investment decision is typically made. But we think there are many other considerations that need to be sort of incorporated into the decision-making process, which matter at least as much in assessing the attractiveness of the holdco as a viable investment. For example, does the company hold, are these underlying companies attractive investments in their own right? Does the company hold multiple separate or separable businesses or disparate assets where value can be built separately and whose latent value can be surfaced separately at different times in the future as the specific opportunities present themselves? Are the management / owners actively focused on building value at these businesses and potentially surfacing these values? All else being equal, we prefer business principles with long-term value creation orientation. Another thing in relation to management / owners, do they have meaningful skin in the game? Do they have meaningful parts of the net worth at risk in this investment? What we do not want are a bunch of absentee owners who collect fees or layer on hefty management expenses. Another thing that we tend to look at is, are the operating costs and financing costs for the holdco low to moderate in relation to the assets? When we talk about costs, we talk about operating costs and financial costs. We prefer ideally low to no debt at the holdco with a low level of recurring financial costs. Remember, cash generation occurs at the level of the operating entities, the holdings, less so at the holding company level. Debt, if any, should be down there at the level of the opcos. Finally, I mean, of course, the starting point of the exercise is the holdco trades at a discount to conservatively estimate a net asset value of the underlying holdings, and then follows the rest of the analysis. So with that as our checklist, let's get to a company that ticks all these boxes and is the focus of my comments today. Straits Trading Company, Straits for short. My comments about Straits are from the perspective of a long-term investor with a 3 to 5 year time horizon. Straits is a Singapore-listed company which was incorporated in 1887. Its current market capitalization is Sing dollars 842 million or US dollars 635 million. Note that with this size, it has virtually no analyst that covers it. In part, I'll get to there's fairly significant insider ownership, but there's enough outside float that's available to investors. So I think that's very little reason why it should not be covered, other than, of course, it is not something that is a traditional sort of trading kind of vehicle investment. So from its roots as a smelting partnership in Malaysia, it has now grown to become a sizable holding company with stakes in real estate, hospitality, resources, and investments, extending all over the Asia-Pacific region and more recently the United Kingdom. The current incarnation of Straits is a result of a hostile takeover in 2008 in which Tessity Group gained control of the company. Tessity Group is one of the entities that manages the assets of the successor of Sri Tan Chit Tuan, the brilliant banker, businessman, and philanthropist who built one of Singapore's largest banks, the Overseas Chinese Banking Corporation, aka OCBC. Tessity is currently managed by his granddaughter, Ms. Chu Get Kim, who's a lawyer by training. Tessity currently holds 74% of Straits. Initially, when Tessity took control of it in this hostile takeover, it was a very, very asset-rich company, although it was arguably indifferently managed. 2008 was also the year of the great global financial crisis and the start of the transformation of Straits. As the liquidity in the markets recovered post-2009, the makeover Straits picked up steam. In this slide, I highlight, it is highlighted the transformation and transactions that took place during the 2010 to 2020 period. I'm sorry, it's a very busy slide with a lot of transacting that happens. So as you can see, in this slide, one of the things that happens is there's quite a bit of selling that went on. So the transformation of Straits to a narrowly focused entity was underway. Let me flag a few notable transactions on this arguably very, very busy timeline. As you can see, of course, one generic comment is that the number of transactions, certainly there's a lot of cleaning up that took place from what Tessity inherited in the starting point of Straits in 2008. Let me highlight a couple of these major transactions, which I think sort of really served to narrow the focus of Straits. In 2012, they acquired the Rendezvous Grand Melbourne Hotel. So now they used to own the hotels in Perth, the Rendezvous hotels in Perth, as well as the one in Singapore. In 2013, along with these hotels in Perth and in Singapore, and of course the one in Melbourne that they acquired in 2012, this was vended to a larger hospitality entity to form a joint venture, Far East Hospitality Holdings Private Limited, FEHH. And that, of course, is a collection of assets that span Singapore, Malaysia, Japan, and Australia. This broadened the exposure by geography, by property type, while also providing with access to scale economies that are afforded by larger hotel owners. In 2014, FEHH entered Europe. So now, of course, Straits is an owner of a much more broader-based hotel chain, FEHH. In 2013, they sold a 41% stake in WBL Holdings, another holding company, a very large holding company, which for about 508 million Sing dollars in cash proceeds. A portion of these proceeds were used to debt reduction, and another portion was paid out to shareholders via an extraordinary dividend. Also in 2013, Straits acquired a 20.1% stake in ARA Asset Management. At the time, a very successful and rapidly growing, initially Asia-focused real estate fund manager. It has since branched out in other parts of the world as well. In 2017, ARA went private, with private equity backing has accelerated its expansion, with Straits retaining a stake in the now private ARA. In 2020, Straits raised its stake in ARA to 22.1%. Also in 2013, which as you can see was a very busy year, Straits established Straits Real Estate, SRE, in conjunction with John Lim, who is the founder of ARA Asset Management. SRE's mission is to make opportunistic investments in real estate. Straits currently owns 89.5% of SRE. SRE is best characterized as an opportunistic global real estate investor rather than developer or hands-on operator. The footprint currently spans Australia, China, Malaysia, Singapore, South Korea, and the UK, which I'll talk about in a little bit. Property types currently include residential, office building, commercial, and logistics properties. So that, and then where does that bring us to today? This is the current configuration of Straits. Okay. As you see, Tessity Group owns 74.1% of Straits Trading, which in turn owns these different entities. Let's talk a little bit about these various entities, what they are and what they do and what they mean. SRE, which is Straits Real Estate Private Limited, which is 89.5% owned by Straits Trading, is neither REIT nor a landlord nor developer per se. They avoid land banking, and they try to minimize development risks. We'll typically look for value-add opportunities. For example, buying distressed, unfinished buildings, completing them, renting them out. When cap rates reduce to reflect a lower level of risk or stabilize the rent roll, they will sell the asset and move on. So that's sort of the kind of real estate owner they are. They're none of the above, not a REIT, not a developer, not a land banker, and so forth. Geographically, the allocation of assets in mid-2020 looked as follows. Australia was 37.4% of the assets. This is comprised of office properties in Sydney and Perth, Central Business District, logistics properties in Adelaide and Melbourne, plus mezzanine financing extended to high-rise residential real estate in Melbourne. China was 23.7%. 2 shopping malls, one in Shanghai and one in Chongqing. Japan was 17.5%. Recently, they've been divesting their residential property holdings, the complete in Osaka and more recently in Tokyo. Basically, that leaves behind a stake in a portfolio mandated to acquire office assets. Malaysia, 15.3%, which is primarily a retail portfolio. South Korea is 6.2%. They're developing a portfolio of logistics facilities in the Greater Seoul area in collaboration with South Korea's largest asset managers. In August, during the throes of the pandemic panic, they acquired a business market in Surrey, England, for Sing dollars 137.9 million. And this is about 30 minutes away from Waterloo Station, very proximate to Heathrow and Gatwick airports. The configuration currently by type of assets is income generating assets is 89.5%, development assets in which there's an equity holding is 8.3%, and development debt financing, the aforementioned mezz lending, is about 2.3%. SRE has experienced fairly rapid growth, rising from $964 million of assets at the end of 2015 to 1.8 billion Sing dollars at mid-20, again, largely opportunity driven. Looking next then at their STC's property portfolio, these are really properties in Singapore and Malaysia specifically. These are sort of quasi-legacy properties which were owned before SRB was constituted. For example, the portfolio in Singapore comprises residential properties in great part freehold land and bungalows thereon. The properties in Malaysia are either 23 acres in Penang. More on that later. Then we have Straits Investment Management. Well, the logical extension of being a private investor in real estate and the skills that come with it, Straits set up an investment manager focused on public real estate securities, Straits Investment Management, SIMCO, which is a registered fund management company regulated by the Monetary Authority of Singapore. Their focus is to identify real estate opportunities in the public markets that are believed to be undervalued, generate strong free cash flow, and offer a solid balance sheet which provides a margin of safety. The funds focus on real estate securities, unlike SRE, which focuses on unlisted real estate investments. SIM advises Nikko Asset Management, Straight Trading Asia, ex-Japan REIT ETF, which is listed in Singapore. The AUM overseen by SIM had risen from 36 million starting in January 2016 to $385 million in August 2020. Turning then to ARA Asset Management Limited. As I mentioned that before, in 2017, when ARA went private, it really was an Asia Pacific fund manager. In 8 countries, managed 11 REITs, 9 private real estate funds with an AUM of about 40 billion Sing dollars. In June 2020, it operated as a manager of real estate in 28 countries. It had a global presence, managed 20 REITs, over 100 private real estate funds, credit funds, and infrastructure funds. ARA oversaw gross assets, including those of its associates and JVs, of 110 billion Sing dollars, already exceeding its 2021 target of 100 billion Sing dollars. As a footnote here, one of the owners of ARA is a private equity firm, Warburg Pincus. I would not be surprised if at some point they would be seeking an exit from their holding, at which point there will be a public market valuation will be easier to see, unless, of course, it's taken over. The next asset in the world of real estate and the real estate ecosystem, overseen by Straits Trading, is Suntec REIT, of which they own 10.3%. The 10.3% of ownership of Suntec REIT that's owned, 2.8% is owned directly, and 7.5% is owned by a fund managed by ARA. The REIT hosts commercial and retail property, principally in Singapore, secondarily in Australia, and now has made its first purchase in London office real estate. Again, this is a publicly listed security trading in the Singapore Stock Exchange. Then there's Far East Hospitality Holdings, which is a private company, which they own 30% of. The portfolio now includes over 95 hotels and 15,000 rooms in Australia, Denmark, Germany, Hungary, Japan, Malaysia, Singapore, and New Zealand. This business has clearly been hit by the COVID-linked plunge in occupancy rates. It nonetheless has continued to be cash positive during 2020. And then is the last holding, Malaysia Smelting Corporation Berhad, of which they own 54.8%. This is listed. This is a listed company trading both on the Kuala Lumpur Stock Exchange and the Singapore Exchange. It owns Malaysia's largest tin mine and is the third largest producer of tin globally. There are really two major developments of note relating to this investment. One, tin is used in the manufacture of smartphones, food packaging, solar cells, and as a catalyst in lithium batteries used for electric vehicles. And as a result is experiencing rapidly rising demand. One would expect that with the proliferation of electric vehicles, you could see continued growth in demand for this product. And of course, and consequently, one would expect smelt to do reasonably well. The second aspect about smelt is less related to the ongoing operations and production of tin. Malaysia Smelting Corporation's operations moved from Butterworth, Penang, to the new smelt in Pulau Indah, Port Klang. Now, this will permit the redevelopment of its prime location in the Butterworth site, of which 13 acres are owned by Malaysian Smelting, and the 23 acres owned by Straits. This is a prime redevelopment site and large one. And there's, of course, fits in the master plan for the development for Penang. And it's a somewhat longer term kind of development project, but it's a very, very large site in a very, very good location. Again, it's jointly owned by Malaysian Smelting, which owns 13 acres, and Straits Trading, which owns 23 acres. It is located about 5 minutes drive from Penang Central, which is an integrated transportation hub for that city. So this is a long sort of this is a long-term development project, and I think this will be a generator of considerable value for the company. So now you have, this is what Straits Trading looks like in terms of its business, the makeup of its different businesses. Let's see what is something like this worth. So here is some of the parts NAV. The first one is, let's talk about ARA. ARA, the valuation, so Straits, as I mentioned, bought 1.11% stake for US $21 million. This equates to 2.5% of AUM, or 16 times trading 12 price earnings, which is reasonable. And so, you know, that's how we arrive at our valuation for this. The 600 6.75 million. Now, the largest shareholder, Mr. Lim, has further noted that it's worth $3 to $4 billion Sing. We are towards the lower end of that range in our valuation. If the growth continues at these rates, I suspect a higher public market valuation will be achieved. Then the two others, Suntec REIT, which is, we only take into account the 2.8% that's directly owned, and the Malaysia Smelting Corp, those are the market valuations. The land we carry at cost. The associates, joint ventures, we carry at cost, and of course in the investment properties we haircut the carrying value by 20% to what the carrying value that they have. Then the investment securities, again, they're at market. We add the cash, investment securities, and netting out the short and long-term debt, we arrive at NAV of Sing dollars per share of 397. Compare that to a current market price of Sing dollars 206, indicates a 48.7% discount to the value. So to conclude, here's a company run by Chuka Kim, a very engaged owner and manager who is operated with a single-minded focus on building value, not just for her family control group, of which she's a part, but also for the other shareholders. Her approach is that of an intellectually flexible, opportunistic, but very disciplined long-term investor, focused on a circle of competence, real estate. They certainly have skin in the game with their 74% ownership. The operating costs in general tend to be relatively modest, about around 1% of assets. The leverage is relatively modest, but then I would also, of course, be remiss not to touch upon the risks. Of course, all investments entail some degree of risk. And so the risks, of course, are, in particular, that attach to real estate that are often ignored. Large, chunky assets, which can periodically experience bouts of illiquidity. In addition, these assets are disproportionately located in the Asia-Pacific region, so there is an element of geographic concentration risk. And finally, the company's success is highly dependent upon the acumen of the individuals who manage it. So there is an element of key personnel risk. There are a few people who have been involved with this. There is a bright, engaged board that's involved. There are, of course, people in the day-to-day oversee these investments, manage them, and are engaged with sort of sourcing them, looking for them in conjunction with the board. So again, there is the key personnel kind of risk. So I would flag these as risks. Let me now stop. I think I've gobbled up most of the time that was allocated to me. And back to you, John, for your comments, questions, what have you.
Terrific. Amit, thank you so much for another interesting presentation. To everyone on the line, if you do have a question for Amit, feel free to type it into the online interface at this time. Perhaps a question, Amit, when you see something like a Straits at a 48% discount, to what extent would you want to know how that discount has fluctuated through time?
Sure. The Straits price used to be much higher. So I've known this company since 2006. In my past life, we were owners of it. In fact, we were, how would I put this? Let's see, without telling stories out of school, we were buying it years and years ago, and it was a jumble of securities. Okay, so there was then this is in 2006 was when we first encountered it, and we started to own it. 2008, January, there was a bid for the outstanding at a much higher price. It really turned out to be a fairly profitable investment for us at the stage. So it was, the valuation has fluctuated over time. Remember, part of the valuation was tied up in a large, very illiquid, chunky holding of the company WBL, which I mentioned. So WBL was sold, and that was monetized. And so then a good chunk of that, the proceeds were paid out as a dividend. This in turn reduced the discount. And of course, Straits continued to build the business, and the business, of course, gradually slenderized. the focus, and of course, the focus narrowed to these areas of activity. And the discount has fluctuated. It has actually widened very sharply during the course of last year. Now, notice during the course of last year, while the discount widened, and the reason I said discount widened, ARA was growing and growing quite rapidly. ARA has, a lot of it is, value is locked up in ARA. ARA is a private company. People don't follow it, except for people who, are interested parties, namely people who are invested in Straits, people invested in ARA, and so forth. So it's ARA used to be a public company. So in the old days, you could always do a much easier sum of the parts. And so, of course, you could have a much easier mark-to-market NAV, and therefore the mark-to-market discount to that NAV. Now it's a bit more obscure. It need not be opaque, because you can actually, ARA has its own website. There are details, some details. It's not quite as transparent as it used to be in the old days. What made this very interesting is there was actually a transaction that took place during 2020 when Straits bought, I think in August last year, a piece of this, of ARA, which allowed us to place a valuation. Separately, comments by John Lim, what he thought the company was worth. Third, you cross-check that against reasonable valuations of companies like, say, Brookfield, for example, Brookfield Asset Management. So just a comment I should make is Brookfield, there's a discount, but it's a very meager discount, because Brookfield is fairly, shall we say, it's liquid, it's large, it's covered by many analysts. In the case of Straits, there are no analysts who cover the company, at least anyone that writes a report on the company. And so the discount, and of course, a big part of the value is tied up in ARA, which is no longer a public company. So you certainly don't get to see what it's worth. And, Straits has historically been a manager of assets, many of which are easy to account for. Now it's harder. So, of course, the discount has widened. So I would suspect its widest probably was during 2020, when it was much cheaper. It was, I think, $1.50, 60 or something like that. I suppose at that point, the discount to NAV would be 50, 60%. And our valuation, I would argue, is actually a fairly conservative valuation. And the underlying is also valued fairly conservatively. So the discount to NAV is probably understated. The real discount might be higher. And what will be very interesting, the triggering event here will be, I suspect, if, as, and when the ARA is taken public, ARA is sold. We don't know what the outcome there is going to be. But certainly ARA had set a target of $100 billion Sing dollars of AUM for 2021. It's already exceeded that in 2020. I suspect the 100 billion is maybe a goalpost, a milestone at which they want to maybe take the company public. I don't know. That could probably wring out some of the discount, reduce the discount once that valuation becomes more transparent.
Interesting, thank you. When it comes to geographies, do you have any preference when you look for these kinds of holding company discount? Are there some markets or countries better in terms of the governance and the protection of minority shareholders than others?
I suspect, you can have actually decent governance in countries where there's less, shall we say, good governance generally. It varies from company to company to company. So, for example, Singapore historically has been viewed favorably from the governance perspective, yet I've seen enough mischief in Singapore that's gone on over the years. So I hesitate to make general comments. On the other hand, Italy, for example, where of course there's long been a reputation of mischief that goes on, I would point out Exor, for example, as a company with, I think, very good quality governance and very, actually quite good management, good holding company oversight by the family, the Agnelli family, the John Elkann who runs it. So it really varies. I mean, I would hesitate to draw inferences from the company. I would really rather more look to the company, the principles, the people involved, and look at the history and how they've dealt with people. For example, we own something in India. It's a holding company called Bajaj Holdings. When we bought it, it had, it had a very rudimentary, very, shall we say, first pass 65% discount to NAV. On a more, if you value stuff more conservatively, it's probably close to 35%. I mean, an excellent family holding company. But there are others where, because there's a control group, you could worry about their intentions. If their intentions, interests, and are oriented with you, the outside shareholder. I mean, so usually it goes beyond just the country, it goes to the level of the company itself.
A question from the queue says, do you have a time frame for a thesis like this to play out? One could argue that the discount has been there for a decade. How long are you willing to wait?
We went to this investment with a time horizon of at least 3 to 5 years, at least. I mean, 3 to 5 years is my basic. Because look, when we bought it, there was a lot of work that was being done. We bought it in about, initially, when we started Moiris was 2015, 16 was when we started to buy this. And so, we're happy to own this, 5, 6, 7 years easily. And because over time, my sort of milestones that I measure are not dollar value of the stock, but what the NAV is. As the NAV builds, and as you see management take steps to build the NAV, credible steps, that we keep an eye on those. And if that is going on, it's fine. If the price has not in the short term responded to all these actions, that is not a source of great concern to me, because to the extent the insiders wish to and intend to surface value, and knowing the insiders, in this case the Testity Group, and historically their shareholder focused orientation, I suspect you will see actions over time that will surface value. So I am not fussed that 4 or 5 years on we've not seen a major uplift in value. Remember, we also had a horrific downturn hit us in the meantime, the one that took place in 2020, from which we're just gradually emerging. And remember, during the 2020 downturn, one of the big investments has actually been building value, which is ARA. The other thing that has happened during 2020, the Japanese investment in apartments, they made a very sizable investment in Osaka and Tokyo-based apartment buildings, which were partly unfinished, which were distressed. They bought them, cleaned them up, fixed them, completed them, rented them out. The risk level diminished, so the cap rates went down, 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 and they've disposed of those. So they realized value there. Separately, they saw an opportunity for distressed investment in the UK in Bern, and they did that. They made that investment as well. So you see them making forward steps in the developing value. So I'm quite happy with that. I mean, if it takes another year or 2 or 3 more before any big steps are taken, e.g. ARA goes public, ARA is sold, that's fine too. That's absolutely fine. I mean, again, some of the things that they're involved in, for example, the land development in Penang, that was, that was signaled, for example, as early as 2012-13, when we originally owned the company, that the land would become available once the smelter had moved. The smelter has been moved. The land cleanup and reclamation is underway and happening. Then it has to fit into a master plan. So there will be successive steps of getting the land permitted, getting the development permissions, and then, of course, a master plan is drawn up. gets the blessing of the city, and of course that's when the development starts. And that could be 3-4 more years. So that's fine. I mean, these are not short-term things, but historically, to the extent that the stuff they've been doing has been, sensible, deliberate, intelligent, I think it's just fine. You will see the NAV move up in steps. For example, when they sell something in SRE. For example, ARA comes public. For example, when the real estate development Penang moves forward. So this is not going to be something that's going to be smooth. So if you're looking, this is the important thing about asset-based investing, as opposed to investing in companies which are, shall we say, going concerns, which generate earnings, revenue, and so forth. Those are different animals. In this case, the NAV builds in fits and starts. It is not a smooth development of either the NAV or the price. So you own this, and it steps up some one day when you least expect it. Suddenly, for example, let's say, this is just hypothetical, okay? Let's say somebody like Brookfield decides that they want to have an exposure to a real estate asset management in Asia. ARA is the biggest company in Asia in real estate fund management, and they buy it out of the blue. Suddenly, out of the blue, there's a bid for this company. So that is when you will see the NAV step up. So I have no idea when it happens, but I want to make sure that I'm there when it happens to benefit from it.
Well, it's probably that patience that earns you the return here, I guess, because the discount exists because it's not clear how quickly things will play out.
I mean, to be clear, this is one of a number of companies in an investment portfolio, and each of those companies has their own rhythms, timelines, and developments that take place. So, this is not the only holding. For them, namely Testity, and for the Tan family holdings, it is clearly a very large part of their holdings. So, they will watch it like hawks, which is great.
Absolutely. Well, Amit, we will leave it there. Thank you so much for joining us today to present this approach to investing in holding companies, as well as the specific example of Straits. We truly appreciate you being with us.
I thank all of you for listening, and John, thank you very much for making this possible. It's much appreciated. Thank you.
Thank you, and everyone who is listening, thank you as well. Do feel free to follow up should you have any further thoughts or questions. Goodbye for now.
Thank you.